is over the past 15 years, demand for ETFs
I do apologize. Just give us a second to get the Executive Director of Capital Markets back on the call. Please bear with us. Okay, I do apologize. I think it's important we hear from him and his opening remarks. But in the meantime, we have with us here a representative from the Securities and Exchange Commission of Nigeria. We have with us here Mrs. Rabi Maidawa, the head Funds Authorization Division at the SEC, representing the DG. And I'd like to invite her now to provide her keynote speech ahead of the opening remarks. Thank you very much. Ms. Rabi, over to you.
Thank you very much, Ms. Chidimma. Good morning, distinguished ladies and gentlemen. I am delighted to deliver the keynote address of the Director General, Mr. Lamido Yoguda, who is unavoidably absent due to his engagement on national assignment. He, however, sends his goodwill and best wishes to NGX and participants at this event. I congratulate the NGX on this event and commend the choice of the theme of this webinar, which is on the fascinating world of exchange-traded funds, a financial instrument that has become increasingly important in the global investment landscape. As the apex regulator responsible for regulating and developing the capital market, the Commission recognizes the significance of ETF in the evolution of our market. Distinguished ladies and gentlemen, it is indeed crucial and apt to discuss a subject that seeks to enhance market development, but more essentially deepen our capital market, as well as improve liquidity in the secondary markets. Exchange-traded funds have emerged as a beacon of innovation, enhancing investment opportunities and contributing substantially to our nation's economic development. It tracks the performance of an underlying index, commodity, currency, or basket of assets, and invests in the components of the underlying. For example, banking index, gold commodity, USD currency, futures contracts, etc. The fund can invest in all or a representative sampling of the components of the underlying. Each investor in an ETF is entitled to a proportional share of the income generated by the scheme and shares the risks as well. ETFs made their debut in the Nigerian market in 2011 with the launching of the new gold exchange-traded fund, which tracks the South African rand price of gold and offers investors exposure to an important commodity market. Since then, ETFs have gained remarkable momentum, attracting both institutional and retail investors, as more funds have been launched, including the Lotus Halal Equity ETF, which invests in Sharia-compliant stocks, and the Vetiver Griffin 30 ETF, which tracks the performance of the NGX 30 index. As of September 2023, there were 12 ETFs listed on the NGX with a total market capitalization of just above 9 billion naira. The ETFs cover various asset classes, sectors, themes, strategies, providing investors with a range of options to suit their preferences and goals. Now, the importance of ETFs in an economy. ETFs have an important role in the sophistication of financial markets, and it is important to provide this context. More importantly, it provides investors with diversified exposure to various asset classes, reducing risks and enhancing portfolio volatility. This diversification is vital for the long-term growth of an economy, as it attracts a broad range of investors and reduces market volatility. Some of the intrinsic benefits of the ETF in the investment landscape include low cost as a result of economies of scale and a passive management strategy. Another aspect is the investment diversification, liquidity, market depth, and access to multiple investment sectors, among others. In addition, ETFs are traded on the stock exchanges throughout the trading day, allowing investors to buy or sell shares at market prices. This liquidity not only ensures that ETFs can enter or exit, investors can enter or exit positions easily, but also contributes to the overall liquidity of the capital market, fostering a healthy trading environment. Furthermore, the lower management fees compared to actively managed funds make them a cost-effective investment option for both individual and institutional investors. Lower costs mean higher returns for investors, which can boost overall economic wealth. Market efficiency is improved by reflecting the underlying value of the assets they track. When ETF prices deviate from the net asset value of the underlying securities, arbitrage opportunities arise, attracting institutional investors who help correct these discrepancies. This process contributes to market stability and ensures fair pricing. ETFs attract institutional investors such as pension funds and insurance companies due to their liquidity and diversification benefits. Increased institutional participation strengthens the capital market, fostering growth and stability. We should also note that the introduction of ETFs encourages innovation in the financial sector. Fund managers create ETFs that track specific sectors, themes, or strategies, providing investors with unique opportunities to invest in emerging industries or market trends. This innovation stimulates economic growth by channeling funds into promising sectors. However, despite all these benefits and importance to the capital market and the economy as a whole, there are some challenges, especially in our developing market. Some of these technical issues will include tracking errors of the funds to their benchmarks and other regulatory concerns. By implementing a robust regulatory framework and enhancing investor education, plus promoting transparency in our market, Nigeria can mitigate these challenges and ensure the sustained growth of its ETF market. Investor education indeed is crucial for the growth and development of the ETF market in Nigeria. Hence, stakeholders need to do more in educating the investing public on the importance and roles of ETFs. In conclusion, the development of the ETF market in Nigeria marks a pivotal moment in our financial history. ETFs play a vital role in diversifying investment options, enhancing liquidity, and promoting market efficiency. As we continue to embrace these financial instruments, regulators, market participants, and investors must collaborate effectively, fostering an environment conducive to innovation and sustainable growth. By recognizing the significance of ETFs in our economy and capital market, we can collectively shape a brighter and more prosperous future for Nigeria and its investors. As stakeholders in the capital market, it is imperative that we continue to collaborate to build a vibrant ETF segment that contributes to the overall growth of our capital market and the national economy. Thank you all for your attention, and I wish you all fruitful deliberations. On behalf of the DG SEC, Mr. Lamido Yoguda, thank you.
Thank you very much, Ms. Rabi Maidawa. It's always a pleasure to have the SEC with us. Other than your primary role of regulatory, the support that you provide the capital markets, investors and institutional investors, as well as issuers, it's very supportive. And we hope that you'll be able to stay on and take questions for us during the course of the webinar, especially your insights into ETFs. It sets a foundation for our speakers that will be speaking today. So with no further ado, okay, I see that Mr. Jude Chiamaka is back on the call. I'll just allow him to finish his opening remarks. And then we'll also have the CEO who should give us just a brief introduction before the webinar continues. Thank you, Mr. Jude Chiemeka.
All right, thank you, Chidima. Let me apologize for the slight technical glitch. So globally, ETFs have grown remarkably this year, recording net flows of $597 billion as at October 2023. According to ETF GI, as at September 2023, the global ETF industry had 11,627 products with 23,560 listings and assets of over $10.31 trillion from 710 providers listed on 80 exchanges in 63 countries. It is interesting to note that in September alone, ETFs gathered net inflows of $67.7 billion with equity-based ETFs reporting net inflows of $43.11 billion, whilst the fixed income and commodities ETFs, ETPs, reported $12.57 billion and $3.6 billion respectively. This highlights the sustained increase in demand for ETFs by institutional and retail investors alike. It is therefore heartwarming that this bespoke instrument is listed and traded on the Nigerian exchange, hence providing investors of all classes limitless opportunity to diversify their investments at relatively lower cost, while gaining exposure to different underlying asset classes. The evolution of ETFs in the Nigerian space began in December 2011 with the cross-listing of ABSA New Gold ETF on the NGX. Since then, the Nigerian ETF market has grown steadily. Total market cap as at October 2023 is 13.59 billion naira. Currently, there are 12 ETFs listed and traded on the exchange. This includes the Greenwich Alpha ETF, Lotus Hala Equity ETF, New Gold ETF, Meristem Growth and Value ETFs, Vetiva Graphene 30 ETF, the Cimerel ETF 40, Stanbic IBTC ETF 30, Vetiva Sector Series ETFs, Banking, Consumer Goods and Industry, and Vetiva S&P Nigerian Sovereign Bond ETF, 10 equity-backed, 1 commodity ETF, and 1 bond ETF in total. We are glad with the immense progress made thus far. Notwithstanding, it's evident that there's an immense potential for growth. Therefore, in line with the exchange's mandate to develop and deepen the ETF market, this masterclass has been curated to provide valuable insights into the intricacies of ETFs and highlight the benefits of leveraging the use of ETFs as an investment vehicle to both retail and institutional investors, as well as potential issuers of ETFs in the Nigerian capital market. Through the course of today's event, our array of speakers will do a deep dive into the Nigerian capital market. And obviously, the essence is really to figure out the mechanisms of ETF vehicles, utilizing ETF strategies, and democratizing investment solutions in today's financial markets. By participating in this masterclass, you will gain in-depth understanding of ETFs and learn how it can be of benefit to issuers and investors in diversifying portfolios. I urge intermediaries in the Nigerian capital market to take lessons from this session on how to replicate the global ETF industry success in Nigeria through product innovation and enhanced service delivery to investors. The exchange, no doubt, remains highly invested in providing an efficient, liquid, and transparent market for investors and businesses in Africa. to access capital and build wealth. We are truly pleased to host this event in collaboration with Vetiva Fund Managers Limited, Narina Visa, Director and co-owner of ETF SA Portfolio Management Company, and the SEC. Once again, I welcome all our guests to this interactive ETF Masterclass and I encourage you to participate actively in the discussions. Thank you very much.
Thank you very much, Chiemeka, for those insightful words in your opening remarks. I would like to now say that we have with us the CEO, Nigerian Exchange Limited, Mr. Temi Popola. I'd like to invite him to provide some few remarks in support of the welcome address. Over to you, Mr. Popola. Thank you.
Thank you very much, Chidima. And let me just say a very good morning to all our distinguished guests. I acknowledge the DG, who is ably represented by Madam Rabi Maidawa, all of our sponsors, the panelists, the facilitators, my colleagues. I welcome everybody this morning. Just to add a few comments, on the subject of ETFs. For those who are connected with our markets, you would find that we've had maybe, 2 cycles of the ETF. We had a very successful era, just like Mr. Chiemeka had touched on now, particularly around, the new gold ETF as an example and a couple other ETFs. I'm making this comment because with the FX environment now that is getting a lot better in our country, I want to, just encourage a lot of our intermediaries as they think about structuring ETFs and launching ETFs. Certainly one demand that we have seen out there is a lot of retail investors and institutional investors actually looking for ways to get a bit more currency exposure through Naira. So I think that there's a very good, strong opportunity there for those who are interested, and the exchange will stand ready to work with you and to support. But away from that, I just want to again welcome everybody this morning. I'm looking forward to all of the insightful things that we'll learn, and I encourage a lot of collaboration today. So thank you again for joining us, and I wish us all very good deliberations. Thank you.
Thank you very much, Mr. Temi Popola, CEO, NGX. Okay, now that we have most of the formalities out of the way, I think it's time for us to dig into why we're here. And to take the first presentation, I'd like to introduce you to Ms. Narina Visa. She's the director and co-owner of ETFs SA, a portfolio management company. Ms. Narina is an ETF strategist and advisor. She offers consultancy and advisory services to the investment industry, financial advisors, and private individuals with specialists focused on exchange-traded products, benchmark indices, and rule-based investment solutions. She's director of ETF SA, which is a registered financial service provider where she oversees the management of specialist investment portfolios of ETF products. She's also, the former president of the CFA Society of South Africa. She has a lot of accolades. She's a member of the Johannesburg Stock Exchange Issuer Regulation Advisory Committee and the Index Advisory Committee. She holds a BSc in Mathematical Statistics and Applied Mathematics from the University of Stellenbosch. And she's a regular market commentator in the media. She hosts an ETF investor podcast and is seasoned speaker at conferences, seminars, and workshops in South Africa. I've taken time out to give her a full introduction so you understand the status of the speaker we have brought here today. And so I'd like to hand over to Ms. Narina Visa, where she gives a presentation leveraging ETFs to build strategies that can help investors meet their long-term investment objectives. Over to you, Narina.
Thank you so much, and thank you for this opportunity. Thank you to the Nigerian Exchange for this invitation. I'm really honored to be here with you today. I have observed the development, the evolution of the exchange-traded fund industry in Nigeria over many years, and I'm very pleased to see where we find ourselves today, where I do believe we're at the cusp of a next wave of evolution. And so in my presentation today, I would like to talk to some of what is already available on the NGX, but I'm certainly also going to try and give you some vision maybe of what could potentially come, both in terms of the range of product that might be available on the market, but also to plant some seeds for investors, for regulators, for the exchange itself, to say, what else, what next, what can we do in terms of this? So allow me to share my presentation screen with you from this side so that I can take you through my presentation. We will have an opportunity for question answer session at the end of my talk. So whilst I'm talking to you, I probably will not be able to observe chat or Q&A or so on. So if you could keep your questions till the end, I will certainly accommodate as many as I possibly can at that time. Right, so what am I going to be covering today in our session? I'm going to start off really just talking a little bit about what are ETFs and why they are attractive. I'm very appreciative of the introductory remarks, the keynote address, much of what's already been mentioned, but I'm going to emphasize and maybe elaborate on some of the points that have already been raised. I'm going to talk about some of the very specific advantages of ETFs, but do so from the perspective of the investor, from the regulator, and also from the exchange, and what it means for issuers of ETFs as well. I'm going to talk a little bit about investment strategies using ETFs, and there's quite a range of different ways in which ETFs are used by investors, both institutional and retail investors around the world. And then even talk about trading strategies. And I think this probably would be more appropriate or suitable for institutional investors, but I'm sure some of the retail investors on the webinar today might also find some interesting insights in terms of how exchange-traded funds are used by investors around the world. So let's get started. Let's start with what are ETFs and why are they so attractive? Now, for me, one of the easiest and best ways to just give like a single definition of an exchange-traded fund would be to say that it is a listed index tracking collective investment scheme. But you'll see that I say that it is necessarily listed. It is usually index tracking, and sometimes it's a collective investment scheme. So what do I mean with that? Well, the aspect why I say it's necessarily listed, it's actually in the name, exchange traded fund. So necessarily we are talking here about an instrument that is listed on the NGX, listed on the stock exchange, and so trades like a normal share, like any other share on the stock exchange. But the underlying investment exposure that the investor gets is a whole portfolio of investments rather than just a single security, a single company, or a single bond, for example. The second aspect that makes it so beneficial because it's listed is that because it's on the exchange, it means that there are real-time pricing right throughout the trading day. So as prices and values of the underlying investments fluctuate during the day, so the price of the ETF will also adjust in real time during the trading day. And so it really allows the investor to buy and sell at prevailing market prices at any time during the trading day. Unlike in the unlisted market where pricing is only done once a day and often only after the fact. So you can only today get whatever the pricing was relevant yesterday. What about the index tracking aspect? Now, this was already mentioned during the introductory remark. Index tracking really just means that we are looking here at a fund, a portfolio of investments that replicates the construct or the makeup of a reference index. Now, certainly all of the ETFs that are currently listed on the Nigerian exchange and the majority of ETFs globally also are of an index tracking nature. But this is not a prerequisite, and we are certainly seeing quite a big growth globally in terms of non-index tracking ETFs, actively managed ETFs, for example. But for now, we can restrict our focus to the benefits of an index tracking portfolio, which really means that the investor gets the exposure to a whole basket, a whole index of securities, but through a single listed entity or listed security. The third aspect of it is the regulatory structure of the collective investment underlying asset that underpins, so the F in that ETF, that underlying fund typically is of a collective investment scheme or a mutual fund nature. Once again, not a prerequisite, but by and large, that is what we'll see, not just in Nigeria, but globally as well. And so much like you have within the collective investment scheme framework also, the unit price of your ETF unit reflects the value of that underlying basket. But as I say, because it's listed on the exchange, it means that it trades right throughout the trading day, and therefore that price, that value also fluctuates and adjusts right throughout the trading day. So as I say, most ETFs are registered as collective investment schemes. And so really this gives you the opportunity to, with a single investment, get exposure to a whole range of investments. Now, these could be an overall market index, an equity market index like the NSE 30, for example, but it could also be an exposure to a particular country or a particular sector, say, for example, just the financial shares. We even have style indices. You know, the Lotus Halal is a Sharia compliant fund. So the underlying index doesn't mean that there's only one single index that could be given through the exposure through that ETF, but really any range of indices within that underlying structure. The unit, which is the listed security on the exchange, is classified as that participatory interest or a share. It's not a derivative. Although the value of the ETF unit is derived from the underlying basket of investments, it is not a derivative. It is actually a direct holding in physical underlying ETFs, underlying securities. But I did say that not all ETFs necessarily have to be collective investment schemes. One have, for example, it could be a special purpose vehicle. I mean, if you think of something like the very first ETF that was listed in Nigeria, the Absa Gold, New Gold ETF, the underlying there is not a collective investment scheme. It's actually held in a debenture structure, a special purpose vehicle that holds the physical gold on behalf of the investors. We also have a growing range of products, other exchange-traded products like exchange-traded notes or depository receipts, ADRs or GDRs or so on. So we tend to use the sort of the catch-all phrase of ETF, but understand that it could be more than just exchange-traded funds. And we will allude to some of these other structures which really provide opportunity to get exposure, sometimes also to assets that are not easily held in physical form. You think like, for example, oil. You can't really hold oil in physical form as the underlying investment of an ETF, but you could do so in an ETN, an exchange-traded note, for example. So we can start thinking about the scope of what could potentially be done in terms of developing the market when we think beyond the constraints or the construct of the collective investment scheme regulatory structure. Another aspect that's really important about exchange-traded funds is that the underlying fund is an open-ended fund. When you have a closed-ended fund, in other words, the size of that underlying fund is issued at a certain size and it's restricted, it remains at that, you then have a situation where potentially the fund can start trading, or the units of that fund can start trading at either a premium or a discount to the net asset value. But when you have an open-ended fund, which holds physical securities, physical assets as the underlying, you can accommodate additional demand or supply in terms of those units by increasing the issue size of the underlying unit and the underlying fund. And that's a really important mechanism to ensure that the ETF always trades at the underlying net asset value. Because if there's excess demand, rather than it trading at a premium, you can find that the issuer can create more units, increase the issue size of that underlying fund, issue more units, and that actually ensures that it trades at the net asset value. In addition, also, you have the role of the market maker, who I guess we could refer to that as the buyer or lender or seller of last resort. So a requirement of the exchange is that there will be a market maker that right throughout the trading day will be a willing buyer and a willing seller in those units. And the price at which it is willing to buy and sell is at that live fair value or that net asset value of the underlying ETF. Now, this is a really powerful mechanism in terms of fair pricing, but also in terms of liquidity. Because that role of the market maker means that the investor is guaranteed to be able to buy or sell at the market price on demand. Because as I say, if there's excess demand for it, the issuer can increase the issue size, buy the underlying securities, increase the issue size, issue more units, and there you've got the increase, you're filling that demand. If an existing investor in an ETF wants to sell that, can sell it back to the issuer, who can sell the underlying securities, redeem some of the units in the fund, and again, it happens at the net asset value. So this is a very important differentiating feature of ETFs compared to ordinary listed securities, where the investor is really dependent on, if you want to buy, you've got to find someone else who's prepared to sell. If you want to sell, you're going to have to find a buyer in the market. But because there's this market maker for an ETF, there's always a willing buyer and seller. When this ETF is what I guess we could call a listed mutual fund, what that listing brings you, in addition to this live and fair value pricing and the guaranteed liquidity, is also the record keeping of the ownership of that unit, which sits in your central register on the stock exchange. And that investment unit is registered in the individual investor's name. So it means your security of ownership, the record keeping of your ownership of that ETF, sits on the central register of the exchange, and there's no need for the issuer of the ETF to keep a record of who holds those units. Of course, because we're dealing with listed securities on a stock exchange, that introduces some additional investor protection and regulation by the stock exchange. So when we think of an ETF as an investment instrument, it's probably one of the best regulated investment options available to investors, because it can be simultaneously regulated by the SEC, by the regulator, as a collective investment scheme, but it's also regulated as a listed security by the stock exchange. So really providing excellent investor protection and safeguarding for investors. So just to reiterate, very important, ETFs are not derivatives. We're not talking futures or options or so. This is not something that gets created through some synthetic replication of some sort. There are physical assets that are held in the underlying fund. It's a ring-fenced fund. It belongs to the investors in the fund. It does not belong to the issuer. So direct ownership for the investor through this very well-regulated structure. In global markets, and certainly in the US, for example, we do have some ETFs that offer gearing or leveraging, but this is not a common aspect of it, and this is certainly something that can be limited by regulations. For example, in the South African regulatory framework, ETFs are not allowed to be geared or leveraged. So even when we look at the US, where this is most common, it is an exceptionally small part of the overall ETF industry. And interestingly enough, often when we see negative news flow or problems within the global ETF industry, almost invariably it relates to these instruments that have some more exotic underlying. Certainly not available in Nigeria at this stage, and I certainly would not recommend that that is introduced by the NGX. So for me, really, when we think in terms of ETFs and how they're best used, and this is certainly how it all started out, is that they are best used to access what we would call beta in the capital asset pricing model, really the overall market return, but to do so at a very low cost, and to also do so with a very high level of certainty. When you are dealing with an index tracking fund that replicates the overall index of the market, it means that what you are getting through that ETF investment is necessarily the performance of that index. So that beta return, that really gives you that certainty in terms of return of the overall market. Actively managed funds can offer alpha, but remember, alpha can be both positive and negative, and it necessarily comes at a higher cost also. So both the underlying exposure that you have in an actively managed fund, but therefore also the relative performance, the performance relative to the overall index of the market is less predictable. So I just want to here just emphasize that when we talk about risk associated with investments, when we say that an ETF is very low risk, what we talk about here is that you get that certainty of the index tracking performance. That doesn't necessarily mean that it is low risk from the perception of the value. If the value of the Nigerian exchange, the overall index, the NSE 30, if that falls, so will the value of your ETF investment that tracks that. Much the same with a gold ETF. If the gold price falls by 10%, the value of your gold ETF is also going to fall by 10%. So there's no guarantee in terms of that the value cannot fluctuate, but the certainty of how it moves in line with the index or the asset, the underlying asset, is where you have very high levels of certainty. So what about these other exchange-traded products? So things like I've mentioned, exchange-traded notes, for example, or depository receipts or whatever. Let's start with the idea of, now for many perception that an ETF and an ETN is really the same thing, but actually the only thing that they have in common is that ET part, the fact that they are both listed on the stock exchange. In the case of an ETN, a note, this is effectively something which is issued by a bank off its balance sheet, so that ETN carries the credit risk of the issuer. And the underlying assets are not necessarily physical assets, because that risk of the underlying now becomes the risk of the issuing bank. It's up to the issuing bank to decide how they're going to hedge their risk. So an ETN is a little bit like a promissory note. The issuing bank promises to pay the investor the performance of that reference asset. How they hedge that risk, how they ensure that they're able to fulfill their promise, is an internal risk management principle for the bank. Now, it might sound like this is a really risky concept, but I want to just emphasize that point number one, when it comes to who the exchange will allow to be an issuer of an ETN, you will find that it will only be highly capitalized and very well regulated banks who can do so. And the second point that I want to make is when we're talking about the credit risk associated with such an instrument, an exchange-traded note, the credit risk is exactly the same as the credit risk that you have of having a savings account with that bank. So if you're prepared to take on the credit risk of an issuing bank by having a savings account with them, it's exactly the same credit risk that you will have by buying an exchange-traded note from that same bank. And certainly the great example, or the great effectiveness or benefits that exchange-traded notes bring is that they do allow us access to investments that are not easily held in physical form. I use the example of oil as a commodity, for example. But we also find that this is an opportunity also to provide exposure or access to international index tracking equity funds. Certainly at the outset of the South African ETN market, some of the earliest ETNs that we had in the South African market was exactly that. The underlying investment was just an international equity ETF, something like an MSCI World or an S&P 500 or a well-known, well-established, large, diversified global equity index. But especially in a market like the Nigerian market, where there are sometimes challenges associated with the FX, with it, but where a lot of money from Nigeria already finds itself being invested in international markets. This represents a great opportunity for the issuers in Nigeria and for the exchange to actually repatriate, bring some of that investment funds back to the Nigerian exchange by offering that same international equity exposure through the likes of an exchange-traded note or a depository receipt, for example. So I certainly look forward to this as a specific area of great development for the Nigerian ETF market, to introduce better exposure to international investments on the local exchange, really bringing a lot of that money that's currently already being invested in global markets, but that accrues no benefit to the Nigerian financial market and economy, to repatriate that, to bring it back to the Nigerian market for all of that benefit to accrue there. So let's maybe then talk a little bit about the advantages of ETFs. And here I'm going to differentiate between, I'm going to put on different hats when I talk about this. I'm going to start with the benefits for the investor. I've already mentioned that the regulatory structure of an ETF makes it one of the most regulated and best protected investment opportunities available to investors. That first level of regulation, which is the stock exchange, and then depending on the nature of the underlying, for example, if it is a collective investment scheme, or if it's a foreign ETF that is already regulated, maybe as a UCITS compliant vehicle in an international market, all of these underlying additional governance and regulatory structures ensure a highly regulated environment in which the investor operates. The transparency of exchange-traded funds, I think, is a very, very powerful aspect of this. Increasingly, we're finding that investors want to know where their money is invested. This is my hard-earned money. This is my hard-earned savings. I want to know, where is my money going? What is it invested in? Am I comfortable with that underlying investment? And often with an actively managed fund, you don't necessarily have that transparency. Whereas if you're investing in an index tracking ETF, that index is known every single day. You've got complete transparency in terms of that underlying portfolio. As an investor, you don't have to wonder about what you're invested in. It's there for all to see. It's like, you can read the label on the box of food that you buy. You can see exactly what's inside your investment. The fact that you've got your settlement, your trading, your registration all done through the Central Securities Clearing System also gives you that transparency in terms of, where is my asset? Where is my ownership in terms of this? The instant liquidity and tradability that is associated with an ETF is also a very powerful aspect of benefit to the investor. Because they trade like regular shares, and you've got this market maker that ensures that you've got that guaranteed liquidity, it introduces a very different type of investment opportunity for an investor. That open-ended structure caters for large trades. So if it's a large institutional investor that comes in, that open-ended structure means it can increase and redeem in size. But for the smaller investor, for the retail investor, that trade will all take place in the secondary market. It will be trade in existing ETF units between buyers and sellers. So a huge boost in terms of liquidity, tradability in terms of this. The benefit of, and I put passive investments in inverted commas. I'm a little bit allergic to that term passive, because passive almost creates this emotion of, oh, it's not doing anything. Nobody's looking after my money. Whereas really the fact that it is index tracking for me is a more appropriate way to describe the strategy of the underlying investment here, where you are investing according to a known set of rules. The rules being the index rules. The index rules that says, what is the basis on which an investment will be selected for this? What is the basis on which it will decide how much, what weight a particular security will have in the index, and therefore, by extension, in the index tracking fund as well. So you have an investment that really gives you this great, exactly the same performance as the reference index, that certainty of relative performance. You're not going to get anything more, but you're also not going to get anything less, except for the costs, because remember, an index is just a mathematical calculation. There's no costs associated with calculating that, whereas a fund that actually invests in those actual underlying securities that make up the index, there are necessarily costs associated with that. But those costs are typically very low, very small component of costs. The diversification benefits that comes through an ETF has already also been addressed in the opening remarks. And absolutely, the fact that you are dealing with a diversified portfolio necessarily reduces the risk, the volatility of that underlying exposure. My apologies. Take a sip of water quickly. So in your investment, you're getting full exposure to all of those underlying assets, the shares that are in your index. And through that, it ensures that you get the same performance as the benchmark, the index would give you. One of the reasons why ETFs are so cost efficient is because there's no need to compensate an active manager who actively makes decisions in terms of what to buy and what to sell. We are dealing here with an investment that follows rules, the index rules. So typically we find that the average costs of these index tracking funds are no more than about 1/3 of actively managed funds. And the larger the ETF, the lower that costs and the bigger the differentiation between that fund of the ETF, the cost of the ETF, and the cost of a similar actively managed funds. Also, very importantly, is that a lot of the trade in ETFs happen in the secondary market. In other words, it's trade of existing ETF units between buyers and sellers. There's no need to go into the underlying market to buy those underlying securities. So those trading costs to manage an exchange-traded fund is significantly lower than that of an actively managed fund. And often those costs are not disclosed as part of the total expense ratio of an actively managed funds. It is something which is paid out of the net asset value. It reduces the net asset value of the fund, but it's not disclosed as a direct cost. And so the investor often doesn't even realize the extent of those almost undisclosed costs, which don't get included in the total expense ratio. So certainly a whole range of benefits and advantages for the investor. What about the stock exchange? Why would the stock exchange be interested in expanding the range here? Well, certainly the stock exchange is in the business of offering investment opportunities, this range of investment opportunities. But as I say, I reckon that there's a significant opportunity set here for a market like Nigeria, where there's quite a lot of money that is currently being managed offshore. It's already invested outside of Nigeria to say, let's onshore that. Let's bring those investment opportunities back to the Nigerian market, where the underlying investment for would still transacting, the asset management, the stockbroking, the custody, all of those sort of benefits now accrue to the local market rather than to the foreign exchange or the foreign market where this is. It also often represents a very good starting point for an exchange for derivative markets, for structured products markets, for example. So the opportunity set for the exchange is to use ETFs almost as a starting point for a much broader range of opportunities. The liquidity we've spoken about on more than one occasion, but I just want to emphasize this again. That market maker that ensures liquidity, that represents buying and selling. So there's transacting on the exchange. It improves the liquidity on the exchange, and so it's certainly very important. When there is the requirement for creating or redeeming ETF units and the underlying is, for example, local listed securities, it means that there's necessarily trade in the underlying securities, which also therefore increases the liquidity in the overall market, not just benefiting the exchange, but certainly benefiting the overall market. That settlement, trading, registration, transfer, all of that done through the CSCS means additional benefit also accruing to another local player in the value chain in the investment industry. It represents new sources of revenue for the exchange, listing fees, for example, but also payment for some of these custodial services, the payment of distributions, for example. But it also really provides a wonderful opportunity for the development of the local financial services industry, stockbroking, market making, structured products, and we're going to get to asset management also in a bit. But obviously, this is a key focus for the exchange in terms of why they are presenting a masterclass such as today, to really assist in the development of the overall financial and investment industry in Nigeria. What about issuers of ETFs? What benefit does this represent an issuer? And our next session is going to be by Vativa, who's going to talk to you about how to be an issuer. You know, what does it take to set it up? And so I'm not going to emphasize too much on the benefits of the issuer, but really just to identify that obviously for the issuer also, this represents multiple sources of revenue. It's not just the management fees or the trading income of those underlying securities in the ETF units, but these these often become great building blocks into other portfolios. Think of almost like fund-of-fund portfolios, or where you have some part of your portfolio being held in ETFs and the rest of the portfolio being made up by individual securities. So for the issuer, a great opportunity to present these building blocks almost for investors. Great cost savings. Let's emphasize this point again in terms of the fact that the ownership record is held by the exchange in terms of the custody, the central register on the exchange. So in an unlisted environment, if you are a CIS issuer, you are required to actually do all of that back office client admin yourself, leading to quite a bit of costs associated with that. But the minute those CIS units are an ETF unit and it's listed on the exchange, that certainly is now done for you by the exchange. And when it comes to things like, for example, quarterly distributions, you are dealing through the CSCS in terms of the payment of those distributions. So your distribution procedure also is significantly simplified. Great cost savings for the issuer. It provides an edge and differentiation in terms of your asset management offering, perhaps, because as I say, often these ETFs represent building blocks that can be put together in a portfolio, either as an entire portfolio made up just of different ETFs, or as part of another more diversified portfolio where you hold some ETF building blocks and some individual shares or securities or bonds, for example. And there's even this growing role in the asset and management industry of ETF strategists, portfolio assemblers. I often refer to myself, and people ask me, well, what do you do all day? I said, well, I play with Lego, because the ETF units for me are really these different Lego blocks. They're different colors and shapes and sizes. And I pick and choose from the different Lego blocks, ETF products that are available to construct portfolios, assemble portfolios for my clients. And depending on what the client wants, whether they want to build a boat or a house or a car from Lego, so clients also have different investment objectives, and these building blocks allow you to customize the type of portfolio that you put together for a client based on the client objective. And this really talks to that core principle of putting clients first. You really demonstrate your commitment to your clients when you're able not only to just reduce the costs, but also to respond to their specific investment objectives in a very transparent way. Because ETFs are so transparent and there's such great information sharing around it, we also find that ETFs certainly allow for a closure of that knowledge gap, that information asymmetry between the professional institutional investment industry and the retail investor who might not be that au fait with investments, to really have an opportunity to close that gap and bring the institutional investor and the retail investor closer to one another. So let's have a quick think about how can we use ETFs from an investment perspective. Now, we've really globally seen the evolution of ETFs through three very distinct phases, and I would argue that we're now entering the fourth phase. The first phase of evolution really was those traditional broad-based equity market indices. So this is where we saw, the very first ETF that was listed, by the way, in Canada, not in the US. The US is not always first. The very first ETF was on the S&P 500, was listed in Canada in 1990. So this is traditionally what we think of as passive investing. It's a very efficient way to get exposure to your broad market beta. You get that at low cost, with transparency, with great operational and tax efficiency. It's a single transaction that the investor makes that gives him exposure to a whole broad-based equity market index. But as much as that first evolution of ETFs were all about equity indices, the second evolution really was to say, but actually this concept of passive can actually be extended to other asset classes as well. We don't only have equity indices, we've got bond indices as well. We might have property indices, we have commodity indices, we've got a whole range of different indices. And so applying this same principle of index tracking portfolios to other asset classes It meant that investors now started or had the opportunity to access multiple asset classes still through the single portal, if I can call it that, or platform of the stock exchange. So whereas we traditionally think of the stock exchange as a place where you only buy listed shares and typically the shares of your local market, now the role of the exchange expands to say, but actually this becomes a platform through which I can access not just local listed shares, but also bonds, listed property companies, and international markets through my local exchange. And you do so with that same ease of transaction, the security of the custody, clearing and settlement, and all of that is done through a single investment platform, which is really what the stock exchange role is in this particular aspect. The third wave of evolution was really when we started moving away from just traditional market cap weighted indices to what is often referred to as smart indices, smart beta indices, or alternative investment strategies. And this was really where we started moving away from market cap only indices to some form of commoditization of active decision making. Think, for example, of an active investment strategy. Let's say it's a value investment strategy, where the strategy of the active manager is to always invest in the 30 shares that have the lowest PE ratio, for argument's sake. That's his strategy. Can you hear that there's a rule in that says the 30 shares with the lowest PE ratio, which means I can turn that into index rules. I can then construct an index on the basis of the 30 shares with the lowest PE ratios. And I can now have an index tracking fund that follows, that replicates that alternative index. No longer the 30 largest shares on the market, but rather the 30 shares with the lowest PE ratio. And so when we see the term smart, just realize that it actually just refers to anything other than market cap weighted indices. So whether this talks about how we select what goes into it, for example, low PE shares or only Sharia compliant shares or whatever the basis for selection might be, or whether the weighting is, I'm not going to just weight these on the basis of size, I might weight to those low PE shares also on the basis of their PE ratio. So moving away from the traditional idea of selection and weighting on the basis of market cap. And what this really gave is that it gave the investor the opportunity to now have access to multiple performance drivers. Because let's face it, size is certainly not the only determinant of performance. But you're able to also access those alternative performance drivers with excellent consistency and let's call it style purity, because the index is not emotional. The index just follows the rules. So your index rules will always result in the same methodology or the same investment style being applied. Here. But our evolution is the one of actively managed ETFs, where the underlying strategy is now no longer index tracking, but it's actually actively managed, because you are now making use of the listed aspect of it, all the benefits of the fact that you're dealing with a listed instrument, but giving you exposure to an actively managed basket. And that is really powerful in terms of it. And I certainly see that that would be a later expansion and development also coming to the Nigerian exchange. So these different strategies are often used for different time horizons. And I'm just going to give you some sort of thoughts around what some of these are. Some of these ETF strategies are really used for long-term, strategic, multi-year sort of strategies, where you either use them to get some sort of core index or an enhanced index exposure. It's a great way also to implement a very specific strategic investment policy or a fixed strategic asset allocation. Once you know what your fixed or strategic asset allocation is, you can implement this on a very long-term view using these building blocks of the ETFs of different asset classes. It can also be used on a strategic basis to actually get specific so-called smart exposures or factor exposures, such as, for example, high dividend paying strategies. So that's typically what we see in the longer multi-year strategic level. But it's also used very effectively for tactical strategies, less than 1 year, for example. One great use of it is to use it to actually allocate cash inflows as you get it into your investment portfolio to actually achieve targeted exposure weights that you're looking for. It's used on a tactical or an active basis to actually tilt the portfolio in favor of something that on a tactical view or a relatively short-term view, you want to be tilted in favor of. We sometimes see these also being used as a form of completion strategy. So you have an existing portfolio that has certain exposures. You don't want to tinker too much with it or mess with the strategy that the fund manager might have around that, but you have the need to actually, but there's a gap in that. There's something that needs to be filled, and certainly a completion strategy can be used very effectively. We also see globally how this is used very effectively for portfolio transitioning. So when you are shifting portfolios from one manager to another or from one investment policy to another, ETFs become very useful tools to actually effect such transitions. And then you've got this sort of range in between, which is both strategic and tactical. I've listed some of them there, but it's really an instrument. Think of an ETF as a tool for you to actually achieve a variety of different incomes and objectives in your investment portfolio. What about this so-called core satellite approach? So when you think of a traditional full active approach in terms of investment management or portfolio management, the active approach is really about saying, I want to outperform my benchmark index or my strategic asset allocation that I've got. This necessarily comes with higher cost. It comes with the risk associated with that level of outperformance. It typically does not have great tax efficiency, and it comes with very specific manager risk. So especially if you are, for example, representing a pension fund and you are now allocating money towards a particular manager, you don't have that certainty in terms of forward-looking performance coming from an active manager. You've only got the historic to go on. On the other end of the spectrum, we've got the index approach, where the index approach says, I'm just going to give you the market returns or the index returns. It's much lower cost. You don't have that manager risk because you are investing according to the index. When you do so within a tax-efficient vehicle, it also gives you some tax efficiencies. But there is the best of both worlds in between, and increasingly we're finding that people are using a so-called core satellite approach. The core would then be something that is consistent with your strategic asset allocation, your overall sort of objectives that you're trying to achieve. And you do so very consistently with lots of purity at low cost, low risk, and so on. And then you surround that by active satellites where you are looking to capture specific alpha that a certain manager might bring, or exposure to a particular investment strategy that's not available in index form that you can then add to that portfolio. And so this really is that best of both worlds. So using ETFs in an investment portfolio does not make you a passive investor. The underlying building blocks might be so-called passive or index tracking, but your choice of which ETFs to use, how much of them I'm going to use it, when to buy into them, those are all very active decisions. So move away also maybe from this perception that when I use an ETF in my investment strategy, I am following a passive approach. You certainly are not. All investment decisions involve active decision-making. The final component is just to look at some trading strategies, for example. So I think this would mostly be relevant to the institutional investors on this call, but I think it's worthwhile maybe just to highlight some of these. An aspect where we see it being used significantly in global markets is cash equitization. So you receive regular inflows into your portfolio, into your fund. It might be regular monthly debit orders. It might be your monthly pension fund contributions, whatever these might be. You receive cash into the portfolio. And you're not necessarily able to immediately deploy that cash into your strategy, or whether it's active investments that you want to target, or whether you want to target a specific sector, for example, you cannot do so immediately. But what you can do is by investing in an ETF, either the broad-based market ETF or a specific, say, a sector ETF, you are equitizing that cash. So you get the equity performance immediately. And then over time, because you've got that guaranteed liquidity and being able to selectively sell out of the ETF as and when you have opportunities available for active individual shares maybe that you use, you can do so when those opportunities arise because you know you've got the guaranteed liquidity on the ETF on the other side. It's a great way to do sector or even asset class rotation. So when, as a house view, a top-down macroeconomic sort of view, you have a specific view in terms of changing asset classes, weights or sector exposures or whatever, this allows you the opportunity to get instant access to that other asset class. And again, over time, you can change that underlying to a more active strategy, but you can do so with very limited market or price impact. So a very useful strategy for large pension funds or institutional investors to use. The ability to use ETFs to provide hedging is limited if you are operating in a long-only environment. But what we do see in many global markets is that they do allow the short selling of ETF units because it actually has a lot less impact than stock-specific shorting strategies. So as the exchange also evolves their own strategies around things like short selling and rules around that, being allowed to short sell ETFs might be a way to actually introduce opportunities to provide hedging instruments to institutional investors that are currently not available. So I sort of use the EFT, and I should probably have said the ETF, the efficient and targeted, also exchange traded fund. You can also think of the E as representing something which is efficient. The T, which would be traded, is actually all about targeted. It's very focused and very specific trading that you're doing. And the F for fast, because you've got that guaranteed liquidity, because you're operating in a broader market where you can actually share a lot of that risk sharing, it provides the opportunity for much more efficient trading and investment strategies than you would typically have with individual securities. Those were the sort of formal thoughts that I wanted to share with you today. And so depending on time availability, I'd be very happy to accommodate questions from the audience at this time. But now I'll leave it up to you to decide how much time we have available for questions at this stage.
Oh, great. Thank you very much, Nerina. I do apologize. I got lost there for a second. I thought I was a participant in the webinar. That was really engaging. I was worried about 40 minutes, remember, but this fully engaged from beginning to end. So thank you very much for that very insightful presentation. I'll ask participants to please put their questions in the Q&A box on Zoom. So we'll just take a couple of questions. I think one of the most overwhelming questions is about the presentation and the recording. With the permission of Nerina, this will be made available to all participants, as well as the recording probably be found on the website, but more information will follow afterwards. I see some questions here. I think clarity, during the course of on the ETNs. So I have an anonymous attendee asking, so can we say banks can use ETNs to raise capital? And are ETNs investors, shareholders, or are ETN investors, shareholders, or creditors of the bank?
Oh, those are great questions. So no, typically ETNs are not issued by the bank in order to raise capital. Rather, the bank allocates some of its balance sheet to hold assets on behalf of these notes that they've issued. So it's certainly not used as a capital raising exercise by the bank. That's the first aspect. I think the second aspect in terms of ownership, no, the investor does not have any claim on the underlying assets. That sits on the balance sheet. But it does mean the bank, because you've got to make sure that the bank is able to make good on its promise, not just of giving you the performance, but also to give you the return of your capital when you need it. So, I almost want to differentiate between return on capital and return of capital. Return on capital would relate to what is the underlying investment and does the bank have the ability to deliver on its promise. And the return of your capital is the credit risk exposure. And that's why, especially also when you look at institutional mandates, there's often a limit in terms of how much credit exposure, for example, a pension fund may be allowed to take on a particular issuing bank.
Thank you for that response, Narina. We have a question here, although I think you might have answered, but just for clarity, the question is from Iro Daniel, is asking, can I leverage ETFs or other assets on the NGX?
It certainly would be a question for the NGX, but I would suspect definitely not. But I'm happy to be corrected if I'm wrong.
So we have someone from the NGX. I'll be speaking to the participants later. So perhaps you'll cover this under his session. The participants also asking about short selling the assets on the NGX. We have a question around the cost saving for the issuer. I think we were mentioning benefits to the issuer. Again, you might just want to give your views, but I think that another speaker will be able to answer this more. But doesn't the issuer pay fees to the CSCS, or does it fall part of the TER of the ETF?
Yeah, that's a great question, and certainly I'm going to leave the bulk of it to our next presenter. But what I can just confirm is, yes, they do pay fees certainly to the exchange and to the CSCS, but those fees are typically not part of the TER, the total expense ratio. So that is part of the cost for the issuer of being an issuer. So they would, within the TER, there would be a component of that is sort of their issuer fee, their management fee of the ETF, not the management of the asset. So you can differentiate between the ManCo, the management company, and the fee that they get for that, and then the fund manager or the portfolio manager of the underlying assets. But I know that will be covered in more detail in the next session. But I think important for the investor to know that what is disclosed in the total expense ratio is transparent and clear, and you know exactly what that total expense ratio is. And there are no additional costs for you as relates to the ETF itself. There's only the costs associated with the buying and the selling. So in other words, the trading on the stock exchange would be the other cost that would be for you, the investor.
Great, thank you for that. Someone here is asking Annie about the range of ETFs. I think she missed the opening remarks. So you can find the list of all the ETFs listed on the exchange on our website. If you check the products that the NGX offers, you'll be able to see a list of all the ETFs that are available on the NGX. I think just following on from your response, someone has asked, an anonymous attendee has asked, are investors limited to buy ETFs on an exchange, or can they directly access the fund through the fund manager?
Aha. The key there is in the name, exchange traded. So you can only buy it on the exchange. The underlying fund might be very similar in terms of that it's a collective investment scheme. If it's an unlisted collective investment scheme, you would buy directly from the manager. And bear in mind, then there's no sort of investor protection associated with that. It's essentially like an OTC transaction. Over the counter, you're dealing directly with the issuer. If that CIS is the underlying the fund of the ETF, and you're buying it on the exchange, not only are you getting that safeguard of the underlying CIS, but you get all of those additional protections because you are dealing on a regulated exchange that does provide investor protection.
Thank you for that. We have another question quickly. Are issuing houses allowed to issue ETFs or just asset managers, fund managers?
So actually, asset managers are not issuers of ETFs. It's specifically issuing houses. An ETF typically has an asset manager as well, but it's just one of the functions within the ETF. So the issuing house is really the ultimate party that is accountable to the exchange as the issuer and also to the SEC as the issuer. one of the functions inside the ETF is that you would have an asset manager, but you would also have a trustee and a custodian. You would also potentially have, there might be a legal advisor, or there might be an auditor, or there are all these other functions as well. So no, asset managers are not issuers of ETFs, but again, I know it's going to be covered well by the Vetiba presentation that's to follow shortly.
Thank you very much. Just in the interest of time, there are a few more questions I think that you can just look through the Q&A and maybe type directly in response to the participants that have asked. But someone here has asked that please can you come and give a similar presentation on REITs? Someone has asked, can you provide consultancy to issuers for ETFs? So all these will engage Nerina. That's just testament to the value that you've added today to this webinar. For that, we're very grateful. So please do stay on, answer some more questions, and maybe we can take additional questions at the end. Thank you very much.
I'll certainly do so. Thank you. Thank you for everybody for the questions and for the engagement. Thank you.
Thank you. So now next on the agenda is we have a presentation from Ms. Oyalede Aibe, the Managing Director of Vetiba Funds Manager Limited. Ms. Oyalede, she's an investment manager professional with over 15 years of experience covering asset management, equity research, product development, and business development. She has been actively involved in the development of exchange-traded funds in the Nigerian industry as a key contributor to the listings of ETFs in Nigeria, including the listing of the New Gold ETF, the first commodity-backed ETF, and listings in the suite of lots of Vetiba's ETFs that are listed, including, the Griffin 30 First Bond ETF, and also, which is also listed, as well as the Nigerian Sovereign Bond ETF. So without further ado, I'm going to welcome Ms. Oyalede to provide a presentation on setting up an ETF business with key considerations around the business model, regulatory landscape, market testing and product development, and the go-to-market strategy and distribution. Ms. Aibe, everybody, thank you.
Thank you. Good morning, everyone. Thank you, Nerina, for that brilliant introduction. It was actually I learned a lot myself. And I think I was probably in the spirit because my cover page actually shows ETFs like building blocks. So we're together on that. Can you hear me clearly, please?
Yes, we can. Please go ahead.
Awesome. Okay, like Chidima had indicated, I'll be speaking on setting up an ETF business, key considerations. Okay, so I'll just take us through a bit of the exchange-traded fund landscape, some of which Nerina has spoken about. Globally, there are currently about 5,400 ETFs that are listed, and the assets stand at about $10.31 trillion as at the end of September. And we've seen these assets continually increase. If we're going by 2023, assets in ETFs have grown by 11.3%. And, just like Nerina mentioned, ETFs are not just, ETFs whilst used commonly also includes other types of exchange-traded products. So globally, we have about 11,000 exchange-traded products with 23,000 listings, 710 providers on 80 exchanges in 63 countries. And equity ETFs in particular account for 77% of global ETFs. And these are information gotten for ETF GI. And I think it's important that we just know to give a context to why we think there are business opportunities in setting up an ETF. Now going to Nigeria, which has also been touched on by several speakers ahead of me. We had the first ETF listed in Nigeria in 2011. And currently we have 12 ETFs that are listed and registered. Some of them I will touch on as we go along. As at September 2023, we had about, in terms of AUM, the ETF AUM was about 9.2 billion, up from where it was at the start of the year, and it's been up 27% year to date. And if we look at the allocation, we can see that globally, equity ETFs account for 77% of ETF allocation across the world. In Nigeria, equities ETF account for 88% of ETFs. And second to equity ETFs, we have the bonds globally. Bonds account for about 19% of the ETF market. whilst bond ETF accounts for 5% of the ETF market in Nigeria. Commodities account for about 2% globally, while commodities account for 6% in Nigeria. And then globally, we have other ETFs. Whilst they may not be significant in terms of percentages, they're still significant sizes. So we have alternatives, we have money market, real estate, mixed asset, and others. Nerina kind of touched on this when she was talking about the different waves, and she says we're in the fourth wave of the ETF trends. So here I just have a depiction of, how ETF trends have been over the years since its inception. So we have the first ETF in 1993, and we can see how, it has progressed from just equity-based ETF to having international ETFs, sector ETFs, bond ETFs, and in 2004 commodity ETFs, and even currency ETFs, and then 2006 now had exchange traded notes, which Nerina touched on significantly, and then the smart ETFs, active-based ETFs, and in 2011, alas, we have it, Nigeria's first listed ETF, and even now we have new types of ETFs that are coming on, but you have the ESG type ETFs, and then we have crypto digital currency ETFs globally. I'd mentioned that in Nigeria, there are currently 12 ETFs. So we have a suite of ETFs from Vertiva, Vertiva Griffin 30, and the sector series, the banking, consumer, and industrial ETFs, and S&P, Vertiva S&P Nigerian Bond ETF. And then we also have New Gold ETF, Lotus, Stanbic IBTC ETF 40 and 30, Greenwich Alpha, and Meristem Value and Growth. And this tells us and shows different styles that each of the various funds have. So we have market capitalization type funds, which are more passive in nature. So we have broad market ETFs, sector specific ETFs. We also have commodity specific ETF, which we have in New Gold. Lotus, there is an ethical and passive ETF. And then we have style ETFs from Meristem with the value ETFs and growth ETFs. So, there's a room for growth in the ETF industry, as we see, if we go by, where the types of ETFs that have been registered globally. There's so many ways we can use ETFs to explore and provide investment solutions for investors in the Nigerian climate. So I'll speak to the product development, because my objective here, or what I've been asked to do really, is to discuss, setting up an ETF and the requirements, what is required. And I think with any business or with any project, you have to basically define your objective. What are you trying to achieve, really? They always say that, you don't start a product or a business without thinking about the solution first. So what's the problem you're trying to solve at the end of the day? And once you know the problem you're trying to solve, then you can identify a commodity or an index or a benchmark that can help you, achieve the objective. I think Nerina mentioned a couple. She mentioned when she was talking about the smart ETFs, for example. So you may want to provide investors with an ETF that gives them access to securities with low volatility or high dividend yield, for example. And then, once you have that objective, you can now create an index around that, or look for a suitable benchmark that may be able to meet the objective you're trying to create. And, one key thing is we're not just creating an index just for the sake of creating an index. We have to ensure that the index and the underlying that would be within the index have to be liquid, because we are looking at a fund that is going to continue to be in existence, a fund that will be able to grow, and a fund that is liquid enough for tradability. There's no point in having a fund where the underlying is not tradable. That means that the investors may not necessarily be able to benefit from such a security. Subsequent to confirming your liquid reference point, then you can now define the legal structures with which you want to design your ETF. So it could either be an ETF, an ETC, that's an exchange traded commodity, or an exchange traded note, or a depository receipt. You'd also consider whether you want the ETF to be a full replication ETF, which is what is permitted in Nigeria. If you wanted to have your ETF as an optimized ETF, or if you want to have your ETF as a leveraged ETF, depending on the climate that you're in. And then finally, you want to consider your trading modalities. You want to ensure that you put in place your market maker to ensure that on the exchange, the securities are actively traded or can be traded as and when investors need to buy or sell. So going on to the objective, I think I've touched on some of that. So when talking about objective, it could be diversification, it could be broad market exposure, it could be access to multi-markets and assets. So these are things that you may want to consider. So if you're looking at broad market exposure, I think that's what we currently have in the market, but there are other ways it could be a broad market exposure to Apologies, I think you lost me for a bit there. Please, can you confirm where I got cut off?
Yes, you can please go. If you share your slides, I think just wants to take the slide before.
So were we here? Can you hear me now, please?
Yes, the next one. Yes, please go ahead.
Okay, thank you. I'd also spoken pertaining to the, sorry, just a minute. I'd also spoken pertaining to, the liquid underlying reference. I'd mentioned price. Okay, I'd mentioned how the underlying asset must be liquid. Something that I probably did not touch on is how pricing must be transparent. I think one of the key things that Nerina harped on was the fact that ETFs are transparent. So the pricing of such an ETF must be transparent and valuation also available on a real-time basis. I touched on the exchange-traded fund structure, exchange-traded note, and exchange-traded commodities. I'll touch on the structure a little bit more in terms of how the asset classes, how the fund can be structured. We talked about physical-based ETFs. So here the ETF is able to fully replicate the securities, and also I talked about the optimized. An optimized version is where the ETF may not be 100% replication, it may be a 99 or 95% replication, and then it uses other instruments to meet the replication of the index that it is tracking or the benchmark that it is tracking. We mentioned the leverage ETF. So here you're talking about having collateralized counterparty exposures. But I will stick to just the physical-based replication because that is what is obtainable in our markets in Nigeria. So here, within the ETF, all securities in the index are purchased into the fund or the ETF structure that is created in the proportion of the weights that are within the index. So a good example would be the NGX 30 index, for example. We have 30 securities on the NGX 30. And that means that when you're creating the fund, those 30 securities are within the NGX 30 must be the same 30 securities that you're holding also in the fund. And not just that you're holding those 30 securities, the securities are held in the same weight as it is held in the fund. So let's say, for example, in the NGX 30, we have some banks there. Maybe you have a First Bank or Zenith Bank, and those are maybe 10% individually. Then it means that even in your fund, you must allocate 10% of the fund to First Bank, another 10% to Zenith Bank, and maybe as it is basically in the index, you must replicate it within your fund. And this is important because with full replication, you're able to ensure that your fund is tracking the index in itself in terms of performance. And that reduces the risk of the fund in the sense that it is not given a risk that is different from the benchmark that you have, informed investors about. The essence of an ETF is to allow investors to exhibit or show or decide their investment preferences based on the objective of the fund. So if you do not fully replicate an ETF that you have indicated that is a full replication, then it means that you'll be deviating and be away from what the performance of that ETF index would be performing, and that means there'll be some sort of tracking error. So here we see, just an example security ABCD. It's fully replicated within the index, as it is in the fund as well. So which means that the fund is going to give the investor an equal, part of the returns that it would the index would typically generate. This is what majority of ETFs globally do. So here, just like Nerina mentioned, with most of the fund structures that we have in Nigeria, we have a custodian, you have a trustee as well. So the assets are ring-fenced within the trust. So there's no issuer risk also, because once you have the assets segregated from the issuer as well, then you know that at any point in time, those securities are safe. And then there's a higher level of transparency, because once you know the constituents of the index, then you know the constituents of the fund, and you know what performance to expect from your investment in the ETF. So the optimized ETF is basically a sample. It's almost like it's still a fiscal based replication. However, it's not 100%. So a good example would be, for example, an index that probably has 3,200 securities, like the Barclays Capital Euro Aggregate Bond Index that has 3,200 bonds. Obviously, it will be difficult for such a security to be 100% replicated due to the cost of acquisition and even some of the securities within the index. And so you would see where investment managers or asset managers in trying to create the ETF may be probably 80%, 90%, 95%, depending replicated of the index. So it's just basically optimizing, but however, ensuring that the objective of the index is fully reflected also within the fund. So for example, in this instance, you may have a bond fund and maybe the average weighted average duration of the fund is maybe 7 years. So that would also be taken into consideration in creating this optimized ETF to make sure that the object of the index is not taken away when you are optimizing in the creation of your ETF. So just generally speaking about the ETF process, so you have the ETF issuer and fund manager. I know that Nerina had mentioned that typically the asset manager is not the issuer, but in Nigeria we have the structure that we currently have is most often than not the fund manager is actually the issuer, but it is possible that the issuer may be separate from the fund manager. So you have the issuer / fund manager who creates this ETF. And then you have the stock exchange sitting in the middle. So the underlying assets reside with the trustee, where the fund manager, creates this securities. So for creation and redemption, there's the market maker, and the market maker is, the entity that ensures liquidity of the securities within the market. So the creation and redemption process is being carried out by the market maker. With this instance, the market maker also trades the ETFs on the floor of the exchange and provides access to institutional investors and retail investors to be able to access the ETFs. So when you want to trade your ETF in a secondary market, you may be facing another investor, but where you have significant holdings or blocks of ETF, you may want to face the market maker directly. So I know Nerina had mentioned liquidity as being one of the key areas of touch points for ETFs. And so you have the market maker being a buyer of last resort if there's no secondary market trading available at that particular point in time within the market. So if you have investors with large block trades, the investors can go directly to the market maker to trade the ETFs. Where your securities are retail, you can trade the ETF retail on the market against another investor, or even nonetheless, even through the market maker as well. Institutional investors are also able to, create and redeem directly with the fund, depending on the size of the fund amounts they have for investment within the fund. So you can see the line institutional investors to the fund. You have the line with the market maker. So there's a creation and redemption cycle that can be done by market makers and also institutional investors. I think one critical thing in developing an ETF business is the regulatory landscape, which cannot be overemphasized. At the end of the day, we want to ensure that we are creating instruments that meet regulatory requirements and instruments where investors are comfortable with the security. The SEC and the NGX actually provide regulatory oversights for exchange-traded funds. So in this instance, before any exchange-traded fund is listed, the exchange-traded fund must receive approval and for the authorization and registration of such a fund. It would also receive approval of the underlying ETFs as well as the custodians and depository of the fund. So what would you typically have submit to the ETF? So to the SEC rather. There are offering document requirements. So within the offer documents, you want to ensure that you've put in all the information pertaining to your ETF, what your ETF objective would be. You want to also disclose procedures for creation and redemption, because liquidity is of key import to the regulators. You want to ensure that investors can go in and out seamlessly. You want to also ensure you're able to provide information that shows and reflects the transparency of your ETF in terms of pricing, in terms of valuation, also in terms of your costs and expenses, such that your ETFs are within reasonable expense ratios. And also, want to ensure you're able to provide information on how investors are able to receive information pertaining to the exchange-traded funds. You also want to provide information pertaining to the redemption process. Exchange-traded funds have two processes for redemption. Number one is the trading in the secondary markets. So any investor can go to the floor of the exchange, just like the same way you trade any security or any stock on the exchange, you would buy and sell the ETF on the floor. However, where the ETF securities that you want to purchase or sell are large, like I'd mentioned, there's a creation and redemption process where you can interface directly with the fund or the market maker. Now, this process is called an in-kind process, and that means that as a large investor or as an institutional investor, you're able to provide, if you want to buy, you're able to provide the underlying securities of that index or of that ETF to the fund manager to be able to get units of the ETF. Or if you're selling, you're able to receive securities from the fund and then in exchange for your units, basically. So you don't necessarily need to trade the securities on the exchange. So let's say, for example, you have someone who has, let's say, Vetiva Griffin 30 ETF, which tracks the NGX 30 index, and the person wants to redeem or a significant portion of whatever they have, they can request to have an in-kind redemption such that they will receive the underlying within the fund as their own. So those securities go to that investor. Or if the investor has securities already part of the NGX 30, the investor can yield those securities to the fund to have units of the ETF. Valuation, I go to valuations. The ETFs are traded daily, so there's a market valuation based on demand and supply. However, like Nerina had mentioned, the possibility of arbitrage, and that's where the market maker comes in, because the market maker tends to take advantage of such arbitrage opportunities as they occur. But there is also the net asset value of the fund, which is the true value of the fund, and that's where the market maker tends to ensure that trading is done on a daily basis. Then we have the regulatory consideration of the NGX. So for the NGX, we have basically the listing rules. Before you bring your ETF to the NGX, obviously you must have received approval from the SEC. You may have prior discussions with the NGX even before the approval from the SEC, but before you can list, you must receive the approval of the SEC. Comply also with the NGX ETF rules, comply with ISA, that's the Investment and Security Act, and every other rule that may be applicable. I think one key thing that the NGX also, we tend to have noticed over the years is that they want to ensure that there's sufficient liquidity of the underlying And I think it's the same thing with the SEC as well. I also want to ensure that there's a transparent computation of the net asset value, and that the ETF data is published and easy to access by investors. So once you're able to meet this regulatory requirements, then we can now, your fund is listed, right? And on listing of your fund, then we can talk about your trading modalities. I think something I should also mention is obviously when you're listing your fund, there are cost implications to listing your fund, even on the regulatory aspect. So you pay the SEC fees for listing of the SEC fees for authorization and registration of your fund, and then you pay the NGX, for example, your listing fees. So those are things that you want to consider in deciding the size of the fund that you want to bring to market. Then I speak to trading modalities. So here the trading modalities is pertaining to, you want to consider your pricing dynamics, you want to consider how you're disseminating information to investors, you want to consider your trading framework as well as liquidity. So pricing dynamics means that how do you compute your ETF's NAV? And that's however you decide to compute your NAV must be consistent and clear. And this depends on the securities that you're holding or the securities that are the underlying of your ETF. So for example, the pricing dynamic of a commodity will be different from the pricing dynamic of an equity-based ETF. So we have in Nigeria New Gold. Now New Gold has a benchmark that it uses for the pricing of its gold. So all this has to be clearly stated. So it has to be consistent. So you don't use a different benchmark today for the price of gold, and then next year you're changing that benchmark. It has to be consistent and referenceable, benchmark for pricing. You talk about information dissemination. So you must ensure that that the pricing components are available to the market participants real time. So a good example would be on the fund manager's platform, you're able to display the prices of your ETF per time. Trading framework as well. Here you want to consider that ETFs trade like any other security in that jurisdiction. So you must have a framework for trading. In Nigeria, what we have is the authorized dealer / market maker. So the market maker has to be, appointed such that you ensure that your ETFs are available for trading continuously, and not just available to trade, but they're available to be a counterparty of last resort, where you have big tickets transactions on your ETF, which talks to the point of liquidity. So here, secondary market trading dynamics, ETFs are traded electronically on the NGX just like any other security. So prices on the NGX are determined by demand and supply. So a good example may be, for example, you may have someone who wants to buy or sell the Vetiver Griffin 30. I know I keep using the Vetiver Griffin 30 ETF because it's so easy for me to remember. But they want to sell the ETF. However, maybe the person needs funds immediately for a personal reason, an emergency need, and so the person sells. The fact that the person has an emergency means that the person is willing to sell desperately. So the person may not necessarily be selling at net asset value of the fund. The person is willing to take a little bit of a loss and just exit that position. So here you'd see that the price of the ETFs traded on the exchange are actually determined by demand and supply. Or however, if you have someone who believes maybe at the end of 2023, going into 2024, that the equities market is going to do greatly well. So people can begin to, for example, allocate resources to the VG30 ETF. And because they are anticipating an uptick in the market going into 2024, they're willing to buy at a price that is more expensive than the net asset value. So here again, you see, the demand aspect, the demand force playing a role in the price of the ETF. But nonetheless, we still have the market maker, and the job of the market maker is to create some stability around the price so that the price is within a reasonable band of the net asset value. Just like any security in terms of settlement, ETFs will settle on a T+3 basis, as we have on the Nigerian Stock Exchange. And the ETF securities will also reside in a CSCS account. So once you have an account with a broker, you can purchase ETFs, and those ETFs will reside within your CSS account and will settle as any other security settles. Secondary market, I've touched on this, I think, severally, that secondary market liquidity is enhanced by the authorized dealer. The authorized dealer is expected to post quotes during trading, to periodically address demand and supply imbalances, as I have mentioned. I'll touch on distribution quickly, and distribution part of the ETF business is all about value, I think. So going to market, at the end of the day, it's about the solution you're bringing. If you remember when I started, in terms of creating your ETF, the first point is to define your objective, define the problem, and define the solution you're bringing. I think once you're able to craft a story that shows this investment rationale to your proposed investor, then it's easier to speak to your investors about your ETF. Investors are always looking for opportunities. They're looking for ways to deploy funds and investments that they have. So who are the typical people that you would speak to? As a prospective ETF issuer, you want to consider the retail market in Nigeria. You want to consider high net worth individuals. Obviously, asset managers. I think something that Nerina harped on was ETFs as building blocks. So asset managers can use ETFs as building blocks for their portfolios. Pension funds can use ETFs as building blocks. So imagine that we have 12 ETFs listed in Nigeria, and they meet different needs. You can use the 12 ETFs to meet a particular investor objective. So let's say an investor believes that the banking sector is going to do excellently well, as well as the industrial goods sector is going to do excellently well. The investor can weight these securities within their portfolio to the taste that they think they want and create a portfolio of ETFs. You also reach out to corporates and cooperatives as well. In terms of, obviously you have to have your marketing materials, you want to have your presentations ready, your decks, your product papers and teasers. Your offering circular that has been approved is always important because it shows what you have presented to the regulators. And I think awareness, educational materials continues to remain relevant, and discussions such as what we are having today is very, very important. You also want to ensure that you have press releases around maybe the times that you're doing your distributions, rebalancing and the like, so that you're creating awareness to the investors to know what you're doing per time on your ETF. In terms of product launch in itself, you can consider having a forum, interviews, advertisements, even institutional client roadshows, and target calls. I think at the end of the day is just ensuring that you're able to maximize all the media channels that are available. So your website, your social media channels, broker forums, online advertisements, and the likes. But yet again, like I'd mentioned, when you're going to market, at the end of the day, what is critical is what you're using the ETF for, the solution that you're bringing to the table. Some of this Nerina has touched on, but these are some important uses of ETFs. Portfolio construction, you're able to use your ETF to fill an allocation that you may require by investment strategy. So this is important for asset managers, for example. ETFs can be used to improve diversification. So your ETF that you're creating, which aspect is it reaching out for? Which aspect is it dealing with in terms of portfolio construction? Is it dealing with exposure to size? Is it dealing with exposure to style or yield or geography or sector? So those are things that you want to consider. You also want to ensure that you're able to explain to an investor how the ETF is going to help them to meet their market views. So is it going to help an investor meet their short-term market views or long-term market view? Is it providing access to an asset class that is hard to find? Is it providing access to a theme that is going to enable the asset manager or investor access that theme much easily, or country, for example? And then you want to also touch on the fact that if the ETF is providing a strategic asset class or asset allocation for such an investor, as well as the exposures that it's bringing. I know Nerina had mentioned, core satellite portfolio, core satellite strategy when she was speaking, and this is a very good example of how a core satellite structure can be used using ETFs. So you have the core being a broad markets ETF here, and then you have other types of ETFs that can form a satellite within the portfolio. So a good example, maybe you can have an NGX 30 based ETF in the middle of your portfolio. Then you can have ETFs that provide access to various sectors in various ways as the investor prefers, depending on the investor's investment profile and investment profile in terms of risk tolerance and liquidity needs and general strategic asset allocation. So here the core is, it's a base, it's the foundation of the portfolio. And that is not necessarily traded all the time. And then you can now have the satellite that is actively managed. So today you can buy the banking ETF, and tomorrow you can buy the industrial, depending on where you see the market moving. You can add a bond ETF to it to give you, some extra diversification. Add the gold ETF, depending on what you see gold doing in the market. So those will now form the satellite of your portfolio. So this is a very good example of how you can use ETFs to create value for your clients and your investor. It's also important, when you're distributing, to be able to show that your ETFs are actually performing what they have been created to perform. So here I've depicted the price movements that we have for Vertiva's equity ETFs. So here we have the Griffin 30 ETF, and we can see Griffin 30 tracks the NGX 30. You can see how close the ETFs have been tracking their benchmarks. You can see the consumer goods ETF as well as the banking ETF and the industrial ETF. Tracking is very key because the objective of the ETF is to, track a benchmark. So if the ETF is not doing that business, then it becomes irrelevant. In conclusion, we think that there are significant opportunities in Nigeria. ETFs in Nigeria just account for 0.45% of collective investment schemes registered in Nigeria. Global ETFs are poised to reach 15 trillion. And so Nigeria has significant untapped potentials in terms of ETF product innovation. And investors continue to demand more product types to help them express their views in the investment space. So we believe that market participants can move into new and unpenetrated investor segments and create new markets with ETFs or whatever ETF structure, exchange traded product structure you want to create. At this point, I think I'll leave it to questions and answers. Thank you very much.
Thank you very much, Oyelade, for that very insightful presentation. I think it's always important for us to get a local practical perspective to these instruments. I mean, but you can see it didn't really differ much from what Nerina had mentioned. But so it's good for us to have seen a very practical approach from a local issuer. And thank you very much for providing clarity around that. We have some questions. I'll ask that you please type your questions in the Q&A box. I think the first question, I'm going to read this out, is from a participant, Adewumi Shebanjo. As market liquidity makes ETFs attractive, are there active market makers in the NSE who provide liquidity for ETF managers and effectively create, redeem, rebalance, and underlying assets ETFs? So I think the question to you is really, how does Vertiva manage market liquidity and market making for your ETFs?
Okay, thank you very much. That's a very good question. So in terms of market makers, so Vertiva's ETFs has a market maker. So the market maker is able to provide liquidity in terms of trading and also in terms of creation and redemption. So where you have a significant block, like I'd mentioned, the market maker is able to assist and facilitate that process. In terms of rebalancing, I think the ETF the Vertiva Griffin 30 ETF has been in existence since 2014. And the index that it replicates is the NGX 30 index. And that index actually rebalances twice a year. So the market maker has consistently rebalanced the ETF twice a year, because if you do not rebalance, the tendency is that your security, that's the ETF, would not track the index. So a market maker has been able to achieve consistent rebalancing of the ETF as well.
Thank you for that, and thanks for providing that. There is some form of liquidity available on the NGX for the ETF. I think following on from your response, and actually another question specifically around, are commodity index futures redeemable? Maybe speak around selling and redeeming your ETFs. Does it have to be a cash value, or can you actually redeem for the underlying assets?
I think it all depends on the structure. The question was pertaining to commodities, am I correct?
Yeah. Yes.
Yes.
Particularly for commodities.
Yes, so it depends on the structure. And like Nerina mentioned, not all commodities are actually full replication. So it's hard for you to go get, for example, if you get a commodity that is oil, you probably will not get your barrel of oil. So there's some instruments, some ETFs that are not, physically backed. However, it depends on the structure with which the ETF or the ETC or ETN was created. So some people may create an ETC that allows the investor access to redeem and receive the commodity. But more often than not, for commodities, it's very unlikely that you redeem and receive your commodity. Its usual redemption for in-kind redemption would typically be for instruments that are easy to transfer and can be, have physical backing as such.
Not to put you on the spot, but do any of the TIVA ETFs allow for a physical redemption?
Yes, all our ETFs actually. So if you hold but it's subject to a particular size. So it's not if you hold 1 unit or 2 units. So you have to have a block. So you can only do in-kind redemption when you have a block, which is usually a significant amount.
Thank you for that. I think there's also a question from an anonymous attendee around, clarifying what you've just said. So SEC Nigeria ETF rules also permit for representative sampling, not just a full replication. I think you just mentioned that. So I think in the interest of time, thank you very much for giving us this presentation and answering the questions. We have some more questions in the Q&A box, so feel free to answer them directly in the Q&A. So with that, I would like to introduce our next speaker, Mr. Kazim Alimi, the head secondary markets at NGX, as he comes here with a presentation and a call to action and discusses with us the NGX's role in developing the Nigerian ETF market and the value proposition for ETFs in today's evolving financial market. Mr. Kazim Alimi.
All right, thank you very much. And thank you very much, Chidima, and all the other speakers. I must confess, so far I've been really impressed, quite rich presentation from both Nerina and Oyelade. I would just want to implore all investors to take advantage of all these opportunities as time goes on. Okay, all right, without further ado, just want to go straight.
All right, Kazim, you can put this in presentation mode so that the viewers can see.
Okay, okay, it's already in presentation mode then.
Okay, well, go. I think there's a button at the bottom right hand. Okay, we can't see it, Isabel. Please go ahead.
Okay, all right. Okay, so essentially most of the things in the first slide have already been covered earlier with regards to the state of ETFs globally. This more or less data from World Forum of Exchanges. So as you can see, North America largely plays a significant role in ETFs, and as well as also to the Eurozone and UK. Most of these have already been covered earlier by Oyelade, so I wouldn't want to dwell too much on all this. But I think most importantly, when you look at Africa, you see the key players, Joburg Exchange, and then also to Nigerian Exchange. As earlier pointed out, we have about 12 ETFs currently. Of course, in the coming months, we are quite hopeful that this number should actually increase as a couple of other issuers are already working on 1 or 2 of these ETFs. So what we've seen also too, essentially for ETFs in our markets has been more of a steady growth, I would say. I mean, we hit the peak 2020, and then as you know, with COVID and all that, recovery began from 2021, gradually 22, and now 23, market cap has significantly improved. I mean, year to date, and we expect that more of this, we'll be able to get more of this before the year runs out, and that would improve further. Without dwelling too much on the styles of the ETFs, I think most of that already been covered there also too as well. So I think I will just go to the NGX role essentially in these ETFs. So one of the things that the NGX has been doing essentially is to work around the operationality of the ETFs. As you know, currently our ETFs are largely they largely settle similar way with most of the securities on the exchange. So currently CSCS as the main deposit settlement institution in the market for NGX, and also to largely also to overall being a very, very big player in that particular aspect. So essentially what we have been able to do is to also engage with them, and then also to engage with other market participants and see how we can reduce the settlement cycle just to improve the experience of investors on that front. So the idea is to drive more interest on that front, and then situation whereby there could be a quick turnover of cash within the period. So the lower the settlement cycle, the more encouraging the turnover is in terms of cash moving around. Then also to product development, which is a very key thing, a very key thing that the exchange is on. We essentially, sorry, can you hear me?
Kazim, yes. Please, can you just close your presentation and open it again, because the slides aren't going through.
Okay.
Just quickly, just go to the slide.
For that. It's been the network. Okay. How about now?
Not quite, but I think we can see the slide. You can go ahead, please. That's fine. I think we can see the current slide now.
Okay. All right. So as I was saying, with regards to products, so that's one aspect that the exchange is really big on. So trying to drive product development, a lot of products on that front. So one of the interesting products we're trying to drive essentially is the depository receipt, which will largely be backed by ETFs as well too. So which more or less an extension of our ETF depository in the market. So our ETF baskets in the market. So essentially that's what that does. It increases our ETF offerings in the market. Then also too, there's been a lot of partnership and engagement with key stakeholders, both on the international level and also to local level as well too. So, and that's likely also tied to some of the products as well, to some of the new products that will be coming up on that. So if you have noticed, to look around the globe, I think you'll have noticed that there's been more of evolution in terms of sustainable kind of ETFs that more or less have themes that are backed by sustainability instruments. So the idea essentially is for us to be able to offer such products as well too. So there's been that engagement also to the key participants, key stakeholders to be able to come up with ideas around that. Also to capacity building, very key. This is an example of one of the things we do in terms of building capacity on this front, because one of the things we've come to realize is that the more education, the more knowledge you share out there, and then the more awareness you drive out there as well too, the more you see interest, and then also to the more improvement you see in the market in terms of liquidity, and then also to in terms of interest in the new product as well too. So those are the things that the exchange is trying to push across, and then to ensure that yes, we're able to develop the market even beyond what the expectations would be. Then also to in terms of value proposition, if you look at ETFs generally from a global point of view, based on PwC's global report of 2021, you notice that ETF market itself is forecasted to actually grow as much as about $18 trillion by 2026. So the idea around this essentially is that there will be more interest in ETFs. There will be more ETFs in the market. So as a result of that, what that simply implies is that there needs to be more effort in driving the knowledge home, in driving the awareness home as well too, so that investors can be able to consider that as something to be done. And also too, I talked about the ESG already also too. So there's the engagement with key stakeholders as well too on delivering on ESG. As you know, Nigeria also has a target in terms of sustainable goals essentially. So the idea is for us to also use the ETFs as well to drive home this particular initiative, and then to have more interest and more products available on the exchange. Then also to expansion into the other markets as well, to which is what I mentioned earlier in the previous slide about depository receipts, and also to being able to tap into the offshore markets. Essentially, as you know, depository receipt more or less about bringing the offshore market outside your own local market, bringing it into your own market without having to move out of, without investors having to move out of your market to go and invest elsewhere, but rather they're able to invest in those securities in their own market, also in their own local currency as well too. So that's the idea around that. Then also too, in terms of regulation, we're also working around that, also to having a lot of engagement with the SEC, and also to that explain that also is evidenced by the support that we've gotten from the SEC so far. And I mean, you see the SEC also spoke earlier, touching on this particular initiative, this particular idea around driving more regulatory engagement in the market, and then so that there could be more confidence and then more trust in the system of the market, essentially. So I think lastly, I would want to implore investors to take advantage of all these initiatives. And then, I mean, we've had very rich and interesting and intriguing presentation lectures, essentially, around that. Sorry. Okay. All right. So we've had a lot of talk around that, and there's been a lot of idea around that. So the bottom line is that we want investors to take advantage of this in terms of tradability, and then also to diversification, to diversify their portfolios. ETFs provide the opportunity, has already been addressed earlier, in the sense that you have a very diversified portfolio and you're able to invest across that. And also to its low costs, essentially, when you compare to you having to invest in even the mutual funds relatively to ETFs, I mean, are more expensive. So ETFs are actually cheaper, essentially. And then also to, I mean, as Oyelade pointed out, imagine you having to replicate a whole portfolio that has over 100 or 1,000 stocks or securities, as it were. It can be quite expensive. So ETFs, the fund manager already takes that role already, goes around that and put things in place around that, and then it becomes easier and cheaper for you as an investor to be able to do that. Then also there's transparency with ETFs, and I think that's one of the good things about ETF. ETFs being listed on the exchange essentially makes it even more transparent relative to other securities or other funds, as it were, that are not essentially listed on an exchange. So that's one of the benefits also that investors will be able to get. And I think at this point I will want to draw a curtain on my presentation, and then probably there could be 1 or 2 questions that could come across from participants. Thank you so much. Over to you, Chidera.
Okay, thank you very much, Kazim, for that presentation. I do apologize to participants that perhaps had difficulty in viewing the presentation, but the presentation will be made available to you following this webinar. I ask that you put your questions in the Q&A box, and then so we should be able to answer them directly. For you, Kazim, I think someone has asked a question. Are there any plans for new ETF listings on the exchange?
Yeah, that's a very good question. So essentially, there are, as I pointed out earlier, the idea is to encourage more issuances of ETFs, and I think that's one of the key essence of the presentation from Oyelade, essentially just to guide potential issuers along the way to be able to take advantage of that. So there are a couple of issuers that we're already engaging with. A couple of issuers who are already interested in issuing ETFs. So the idea is that there will be more ETFs that will be coming on board in the coming months. And then also to via other products as well, to like depository receipts, there could be also more benefits that will come in terms of ETFs being the underlying security essentially around that. So there could be more exposure, there could be opportunity for investors to be able to get exposure to the S&P 500 or the FTSE 100 essentially, and then be able to use their Naira essentially to be able to achieve that.
Right, thank you very much. We're going to be able to put contact information in the chat box and the Q&A, so you can reach out to.
I think you're muted. I can't hear you.
Sorry, can everyone else hear me?
Yes.
Okay.
Okay,
all right.
I can hear you. Yeah.
Okay, so we'll provide contact information for Kazim, who heads the secondary markets department, primarily responsible for the listing and trading of ETFs at the exchange. And with that, I do believe the webinar will come to a close. I want to thank everybody, all the speakers here. This has been very insightful. I mean, throughout the whole webinar, I had my investor hat on, my portfolio manager hat on, my regulator hat on, my issuer hat on. So I think it has provided insight for a wide range of stakeholders that have been participating in this webinar. And with that, I'd like to call again, thank you, Ms. Rabi, Narina, Oyalade, for all your contributions. And we hope we'll be able to call on you in future for more presentations and assistance with us in educating our investors and capital markets. Kazim, I'd now like to hand over to Mr. Kazim Alini to give the closing remarks. Thank you.
Hello, can you hear me? Okay. All right, thank you very much. Thank you very much, Chidima. Distinguished ladies and gentlemen, thank you all for participating in this laudable event. We are delighted at the learnings and contributions from various subject matter experts during this ETF Masterclass. Certainly, the thoughts and ideas shared in today's sessions have provided broad insights and also more or less ideas into how to leverage ETFs to build strategies that can help investors and issuers meet their long-term investment objectives. Today's masterclass highlighted the mechanics of creating ETF vehicles and also to the value proposition. It's very positive that all stakeholders and participants have benefited measurably. We believe that today's event would serve as a catalyst to improve the participation of retail and institutional investors as well as issuers in capital markets. It is the exchange's belief that there would be more traction geared at deepening the Nigerian ETF market essentially, and also I would at this junction reiterate that the exchange is very big on investor education and capacity building. Going forward, the exchange will continue to leverage relationships and partnerships to organize workshops, webinars, conferences to support market education and awareness for financial literacy. Lastly, on behalf of the board of directors, management, and staff of the Nigerian Exchange, my profound gratitude goes to the apex regulator, the SEC. I would also, in the same vein, like to appreciate our esteemed partners, Vertiva Fund Managers, represented here by Oyelade as the MD of Vertiva Fund Managers, and also to Nerina Vaisa, Director and co-owner of ETF SA Portfolio Management Company. And I would also like to appreciate my colleagues as well too at the exchange as well to being for their tireless effort in ensuring the success of this event. Your support and presence is very much appreciated. Thank you very much and enjoy the rest of your day. Thank you.
Great. Thank you very much, Kazima. Thank you to everyone on the call. Do enjoy the rest of your day. Thank you.
Thanks, everybody. Great stuff.
Thank you very much.